In an upcoming video series, we will look at how the Bank of Canada's policy rate affects other banks' prime rates and what it means to borrowers. The bank's interest rate impacts a lot of what happens in the Canadian financial system. But it isn't the only important variable that investors should know about. Another common figure that plays a role in the market is what is known as bond yields, which is what we're going to look at in this video series. The role that these play in mortgages and other borrowing is similar to the overnight rate. When bond yields change, the bank takes the change into account, which then gets passed on to the borrower. Bond yields are crucial in understanding how fixed rate mortgage rates are set. So let's begin. What are government bonds? A bond is a kind of investment product that is most popular for its low risk and reliable returns. When you buy a bond yield, you are, in essence, acting as a lender to the Bank of Canada. The bank will take your money and put it towards government spending, or wasting, and debts, and will issue you interest over time. Once your bond reaches maturity, you are paid back the principal amount in full. Government bonds are thought to be extremely low risk. Some even say zero risk. This is because the bonds are guaranteed by the government themselves, making them some of the most secure investments around. In theory, the government could fall apart and fail to honor your bond, but if that happens, you probably have a lot more to worry about. There are a variety of bonds offered, each with different times to maturity. Generally, the longer the maturity period, the higher the yield, but the longer you will need to wait to see your principal repaid. Bank of Canada bonds can be as short as 1 year and as high as 30 years. The downside is that in investing, the higher the risk, the higher the potential returns. Bonds, with their remarkably low risk, don't pay as much interest compared to many other investment avenues. This isn't Tesla, folks. This makes them a good option for those looking for somewhere to hold money they can't risk losing, but not great for those hoping to see it grow quickly. Bonds are primarily issued to banks who then sell them as investment products to clients. Bonds can be held to collect on their interest or bought and sold at any time to other investors. When a bond is sold on the market, it may be sold for more or less than its initial value. All right, thanks for watching this one. We will pick it up next time with what are bond yields.